What is financial freedom? The term financial freedom is getting a lot of limelight on social media these days. There's the acronym FIRE, which stands for Financial Independence, Retire Early. FIRE is a key area of focus for the Reddit community and the general personal finance landscape. It seems like a relatively large proportion of millennials are striving for financial independence when previous generations, on the other hand, toiled for years and years in jobs they didn't like at the expense of their physical and mental health. Escaping the rat race and pursuing your passions is where the narrative has shifted to in recent years. What is the standard definition of financial freedom? Well, after a quick Google search, the results showed that financial freedom was finding yourself in a position where you don't need to work unless you want to. This definition could be clearer, so in this episode, I'm going to give you my definition of financial freedom and how it could be achieved. Financial freedom can be defined as the situation where the natural yield on your invested capital meets your desired standard of living. So let's break this down. So natural yield, firstly, this refers to the cash flows that are paid from different kinds of investments. So for example, shares can pay dividends, bonds can pay coupons, and owning real estate can provide rental income. Desired standard of living, that is an explicit monetary amount which is enough to fund your retirement. For example, £35,000 a year. How much capital do you need to achieve financial freedom? Well, that depends on two factors. So firstly, it depends on the level of natural yield that you're getting from your investments. So say, for example, your natural yield was 4%. This means that for every £100 that you have invested, you will get £4 of cash flow or passive income from those investments every single year. A high yield will therefore provide more income than a lower yield, all else being constant. Your desired standard of living. So are you someone that wants to go on lots of holidays every year, spend frivolously, eat out at fancy restaurants? This would mean that you need more money every year to fund your lifestyle than someone who spends more frugally and is tighter with their money. The graph on the screen now shows a relationship between portfolio value and income that can be achieved when you vary the yield on your portfolio. So in this case, we've assumed a portfolio yield of 3%, 4% and 5%. Say your portfolio yielded 5% and you wanted an income of £20,000 a year. That means that you need approximately £400,000 of capital in order to meet that income objective. It's important to note here that we're not assuming that you're paying any tax in a given tax year. In practice, the impact of tax means that you need additional portfolio value to result in a net income of £20,000 a year. And as you can see from this graph and table, it's clear that for higher yielding portfolios, you need less capital value in order to meet your income objectives. Okay, so should I maximize the yield on my portfolio then? Not so fast. So the pursuit of yield is fraught with risk. Current dividend yields are not indicative of future income levels. For example, the company British American Tobacco has a current dividend yield that is quoted of around 9.6%. And that is effectively the aggregation of all prior dividend payments over the last 12 months divided by the current share price. So just because it's quoted as 9.5% or 9.6% does not mean that that will be the case for the next 12 months. A high dividend yield could signify deteriorating company fundamentals, which ultimately lead to lower dividend payments in the future. So proceed with caution if you're looking to buy high yield stocks to fund your retirement. What about bonds though? Bondholders rank above shareholders if a company goes bankrupt. So there's less risk associated with investing in bonds than shares. However, companies can still default on their debt, resulting in a permanent loss of capital to the investors. It's therefore really important that if you're looking to buy bonds, you understand the underlying credit worthiness of the institution. Are they a safe pair of hands? Is the yield that is quoted secure on a forward-looking basis? Diversifying your portfolio across a wide range of asset classes, so for example shares, bonds, and maybe a bit of property, will likely smooth your returns over the long term. You can also further reduce your risk by investing in funds or ETFs or investment trusts, which all contain baskets of underlying securities. So for example, instead of buying shares in British American Tobacco, you can buy shares in an ETF or a fund which track high yielding shares across the whole of the FTSE 100, for example. As at the time of recording this video, the following indices and funds have the following yields. It's important that you are flexible with your income requirements when it comes to financial freedom. If you're unwilling to reduce your spending in poor market conditions, this can lead you to effectively kicking your portfolio while it's down, and this is something called pound cost ravaging, where you're basically crystallizing losses and you're not giving your portfolio time to recover. And this is really harmful in a situation where you're trying to make your portfolio last for a prolonged period of time through retirement. What actions can you take today? Well, the first action is that you should save and invest on a regular basis. In order to benefit from a capitalist society, you need to accumulate capital. So this involves buying up things like stocks and shares, bonds, and property. These assets will generate passive income, which can help fund your retirement and generate financial freedom. The second step you can take is to calculate the cost of retirement, so the annual amount you'll need to spend in order to meet your desired standard of living. According to the Pensions and Lifetime Savings Association, or the PLSA, they've calculated approximate amounts that you need to spend every year in order to have a minimum standard of retirement, a moderate standard, or more comfortable. And for a single person, this ranges from £14,400 per year to £43,100. If you're in a couple, you'll benefit from economies of scale, so the amount of money you need is not double, but it's more than a single person would need. If we take the PLSA's moderate estimate for a retirement of £31,300, and we assume that the natural yield on your portfolio is in the ballpark of 4.5% per annum, this means that without including tax into the modelling, you'll need just under £700,000 of capital in order to meet that income target. In the wise words of Warren Buffett, if you don't find a way to make money while you sleep, you'll work until you die. Accumulating a diversified portfolio which yields cash flow will give you time and peace of mind to actually pursue the other things in your life which are really important to you. Don't think of retirement as a phase of life when you're old and decrepit. Think of retirement as a time of your life when you no longer need to transact your time for money. This is a key step to ensure financial freedom. And with that, I'll end the video. If you made it to the end of the video, thanks very much. Please leave a like if you enjoyed the video and subscribe to be notified of more content. Thanks very much. Cheers.